FTF is looking to sell a single-tenant property, US Bancorp Center, to Viking off-market. And we are talking about a trophy building here, Class A built-to-suit office in the CBD of Minneapolis. However, this off-market acquisition opportunity is exclusive to us only until the year end. That is, we have 2 months to close. Today, we are here to recommend Viking to offer at $170 million for this property. This might not be the wildest number that you could imagine, not the lowest bid. However, we do not want to lose this bid because we're expecting hot money to come in from China, from other parts of the United States to Minneapolis. And if this property is marketed openly after the year end, we could lose the bid. So back to the price, this is implying an initial cap of 7.9%. And with our proposed leasing strategies in the different scenarios, we are looking at an exit cap of 6 to 6.4%. So having this end goal in our mind, I'm going to walk you through a little bit more about the crucial deal background. And for this single-tenant property, the lease terms with our single-tenant USB is very crucial. So in the year 2018, that is 2 years from now, USB will notify of the property owner that effective from 2020, what sort of renewal options, what sort of renewal decision they have made. They can opt to go for a 5, 10, 15 or so year options, and they can also opt to go for A to D, that is the different full or partial renewal. So as you can see here, as the notification period is 2 years later, a big wild card is here for our expected well exit. And this is very crucial. However, the natural question is whether we can do it, whether we can secure this piece of information right now before we close. So having considered the selling motivation by FTF, we figured that if it is actually possible, they would not have offered this property off market to us in the first place right now. Therefore, the next analysis by Nancy regarding the situation, the renewal of USB's possibilities, is going to be based on the 2018 point of view.
Thank you, Pinky. Regarding the performance of the Minneapolis office market, we have noticed that there's a strong rental growth in recent years, especially for the Class A CBD buildings. We believe this trend is going to continue for the near future, pushing USB more motivated to renew with us in 2018 at a flat below market rate. Apart from the rent concern, USB itself also has a very stable real estate need. The development outlook of the macro environment seems optimistic, but I would like to draw your attention to the company's stable headcount over the last decade. It is also very possible for them to move in the back office staff from the US Bank Plaza in 2019, taking up the current vacant space in our property. So considering the increased on-site headcount as well as the possible future expansion opportunities, we believe that despite USB's attempt to increase layout efficiency, they're still going to need a significant amount of office spaces. Well, even if they do want to relocate, there's not much options available in the market right now. USB can either go for an existing building, take up an under development project, or have a new build-to-suit. Well, given the market supply, we know that there's only very limited available spaces for the Class A building in the core CBD region. As for the under development projects, their limited amenities made them less desirable for UBS to relocate. While as for the build-to-suit options, not only it is very costly, the largest available land parcel in downtown Minneapolis right now is only half the size of our current property. So given the consideration of all these options, we are very confident that USB is going to renew with us in 2018, utilizing option A or B.
Thank you, Nancy. And aside from lease option, lease term is also a very important factor for us to decide the initial cap rate. In order to get an initial cap rate, what we're going to do is we're going to assess the probability of different renewal terms or renewal scenarios, and then we will get a blended cap rate and we will get the valuation. Now, put yourself into USB. We believe that there will be 3 factors that they will use in deciding the renewal terms. First, TI, second, rent discount, and third, flexibility. Now, as USB is a tenant, it makes total sense that they would like to maximize the TI and also rent discount. That's why if USB is going to renew with us for a 10-year lease term, we are going to give them extra TI in order to extend the stay. At the same time, Minneapolis is actually experiencing a 4% growth of office rental income in the past few years. That's why if USB is going to sign a 10-year lease in 2018 with us, they're going to secure a below market rent, and also they're going to save themselves quite lots of money. And that is the attribution why we think that 10-year would be the most probable scenario. Now, on the right-hand side, from all this attribute, we get the 7.8 cap rate. Please be reminded that this 7.8 cap rate, we already blend in the possibility of different scenario, and this is the cap rate. With this cap rate, we would have a valuation of $174 million. But bear in mind that FTF actually wants a more familiar buyer. They actually want to sell this property. They want to seal this deal by December, and this is a single-tenant build-to-fit property, which give us the reason why we think that we could get a bargain. We could get a bargain of 2%, making our offer price into $170 million. Now here's the bigger question. Will they accept a price? Indeed, according to sales comparables in Minneapolis in the past 5 years, our price per square feet actually fits in the market range. And even more, it actually outdoes some of the comparables, which is the basic reason why we think $170 million will be a good beat for FTF.
For investment outcome, there are two scenarios. The first one is USB going to renew for full occupancy. The second one is USB going to vacate partially and leasing only around 80% of our office spaces. As following Adrian's logic, with the TI we have and also the rent discount, we are going to, they're very likely to have a 10 years lease. We also include a worst case scenario, which is C, the USB is going to vacate completely and leaving the property. So Lucas and I are going to talk about the business strategy we have and also the project level leverage investment outcome. So here is our general assumptions for our scenarios. For the first scenario, it is the most favorable for exit because once USB renew the full occupancy, we are going to have a WAIR of 12 years. Therefore, we will have a hold period of 2 years, which after the renewal of USB, we are going to sell the property immediately. As I've mentioned about the TI incentive, we are going to provide a $30 per square feet TI incentive if they sign a 10 years lease with us. It will result in a leverage IRR of 36.7% and also an EM of 1.7. We have also done our sensitivity analysis. I would like you to focus on the lower table. We can see the blue one is our current scenario, which is 10 years lease. If we are doing a 5 years lease, we will still end up with an IRR of 28.4% and also an EM of 1.5. So in scenario A, no matter how long the lease term are, if they sign a contract with us for a full occupancy, it is a very promising return we're going to have.
Thank you, Sandy, for talking about the most favorable A scenario. And now I'll walk you through about the B scenario, whereas the USB choose to vacate partially and just will leave some vacant space for us to fill in. Here our mission is simple. We need to introduce some new tenants here. We have two strategies behind this motion. Is that the first one is very straightforward. We want to prolong the WAIR such that we secure a more stable and long-term return. And in return that, we'll have a more comfortable and better cap at exit. The second strategy behind is that we did consider about using office tenants, retail tenants, or even residential tenants. Given the timeliness of this presentation, I'll just stick with the most sensible office tenants here. But if you want to explore the opportunities for the retail and residential market, just try to get us to during the Q&A section. So with the office tenant in mind, here I will try to give you the direction of which kinds of tenants we will try to introduce. Here, we do not limit ourselves just to introduce the tech and legal tenants, but they have some strong evidence showing us that we could minimize our lease expiration risk in this case. Here are the favorable macros that show us that in the tech and legal tenants, they will have a very strong business environment as they have a strong employment growth and job growth. This suggests a stable, long lease demand as they have a long-term retail needs in the following years. What's more exciting is that you can look at the recent transaction happening in Minneapolis. The lease activities in 2016 here illustrates that there are tenants of tax and legal firms they are taking up huge spaces with a long lease terms with 10 or even 10 plus. This shows us that they have a demand in the areas. They're actually moving into the Minneapolis CBD or office spaces, and they will love our property. In the sense that we are very comfortable that our strategy of introducing new tenants could be very comfortable. Now, here's the financial returns pages, and with the key assumption of holding period of 6 years, here we made 2 rationales behind. The first is that if after the 2 years of notice period, we will try to have to introduce the new tenants, we'll have 4 years time to do it, which is a comfortable timeline. The second rationale behind is that at the year exit of 2022, we no longer need to pay a 35% of huge participation fee to US Bank Corp anymore. In this case, we'll arrive at this level of IRR and equity multiple. If you are indulged with our assumptions, please refer to this sensitivity analysis we prepared. Now let me walk you through about the last scenario is what if USB vacates completely? As a single tenant property, I believe that, and we understand that it would be a biggest risk if it's just vacates completely and leave an empty building for us. Here, we'll just stick to the strategy as we'll just try to maximize the occupancy and WALE at our best effort. Here, we still stick to the holding period of 6 years, arrive at IRR of 5.7% and a 1.04 equity multiple. This is a downside of a project that we understand. But given that this is very unlikely in this work scenario, in the sense that we are saying that the 5th largest US commercial bank are going to exit and vacate their headquarters in 2 years' time. We don't believe this will happen, and this valuation provides us actually a good downside protection in the worst case scenarios.
So to sum it up, we'd like to analyze that all our strategies apply to all scenarios. We're transforming a risky single-tenant property into one that at exit with at least 8-year WALEs. I want to draw attention to the bottom right corner that at that moment, if USB vacates completely, we still have an equity multiple at par. So how are we going to value this attractive opportunity? Since Viking do not have the sufficient equity capital to finance the entire deal, we'll do it with a financial sponsor and have Viking acting as the operating partner. And so, in choosing for the equity partner, we'd like to choose the private equity. Because of the pension funds and the REITs funds, they have the mandate that they need at least a WALE of 5 years. But for our property, it's only 4. And so we also understand that for private equity, they have the appetite in Minneapolis. In the recent transactions in Americas, they do have transactions in the similar property in this year. And also, we want to highlight that after deciding we are partnering with private equity, so how much that Viking should actually participate in this deal. We are ranging the analysis from 5% to 10%. And we also have a promo structure as listed above. Viking will also be earning 0.2% of the property value as the asset management fee. And you can see that in this 5% scenario, both parties have a pretty positive returns. But we're now proposing that instead of 5%, Viking should take a part of 10%. We understand and aware that the internal rate of return is lower in this scenario. However, we understand that Viking is having a difficulty in allocating and finding good opportunities in the regions. So we do think that this is a good investment that they can take for a better profit and also better equity multiple. And also for debt financings, we are choosing the FTF seller because of the favorable rates and also for initial lease terms that it covers all scenarios over 6 years. And in terms of risk rewards, we do believe that we are subject to the renewed or new lease terms. But in all of scenario analysis, we try to use 10 years. But we did a sensitivity analysis, even if it's just 5 years, we got a pretty good returns as a safeguard. And also for the office market outlook, because of the B scenarios or C scenarios, we got to subject to the market conditions, the rate. And we are still confident as long as we have a 2% annual growth rate in Minneapolis. And we are having a very tight schedule here. In the next steps, we have to do a lot of due diligence in understanding appetite of USB and also to do a roadshow for our private equity partner. Finally, I would like to come to a conclusion that we are to reiterate a buy signal for US Bank Center at $117 million. We're going to finance the entire project with a joint venture structured with a private equity fund. And we are very confident that we're going to win this bid with our offer price, and the price is not going to be released into the market. And finally, we are very happy for any questions. We can go back to any discussions in the entire presentation. Thank you for your time.
Thank you.
Thank you very much. Questions?
Yes.
So you have 3 scenarios.
Yes.
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 Only the first one, it seemed, and it went by really fast. So you had a lot of information there, so maybe you can clarify. It seemed like only the first one met the hurdle of your private equity partner of 16%.
Oh,
And so I'm wondering if you really can convince someone that with anything other than your base case, I guess you need it.
actually,
Second.
right. Even with only the 10% participations, actually the base case, we do hit it with 12% hurdle for the first hurdle. But
Well, because I thought you said it was in your other slide where you're choosing a partner. It said that the private equity firm would want 16%. 16% IRR.
right. First of all, this is a common mandate that we understand that the markets of private equity appetite is about 16%. But the reasons that we had the first hurdle is just to make a fair profit sharing. So it is not something that we have to make up for, and we do believe that the possibility for A and B is actually equals. Because we actually do not being very able to identify how much that they can renew completely or partially. For that, A and B is actually in the same possibility.
Did you promote structure of 20 over 12 and a 50 over 20? Is that how you did it?
Yes. For the reason why we chose the 12% hurdle is that
The whole scenario.
right.
Right.
Can you go to the next slide?
Right.
Scenario A. Your deal IRR is 37%. You would expect, the PE to get less and the promote partner to get more, but they're both underneath the deal IRR.
It's actually because of 35% participation fee. Because we got exited earlier than 2020, so we got to pay. So the one who actually get benefits is
The
USB.
deal IRR has to reflect that.
Right.
Okay.
Got it. Thanks for
you.
that.
So can you talk about that, just how you thought about the participation? And I wasn't quite sure what the rents were in both scenarios.
Okay.
Scenario A
I'm-
and scenario B.
Sure.
Did you use what was in the
Market
case, or
rents.
did you do your own analysis of what you think the appropriate?
What about Pinky go for the A first and then?
Okay,
Thanks.
so first of all, I'm going to go through our consideration about the 35% participation. So we do understand that before 2020, any transaction of the property, there will be a 35% of participation paid to USB. And this is exactly why in the scenario B, we are selecting a whole period of 6 years after year 2020. And this is why we came up with the whole period in the second,
Right.
whereas the market.
But just, I don't mean to interrupt, but do you know that because of that, USB actually said if you don't sell it on 2020, we're going to have a valuation date to determine what the value is. So they want, I don't know if you factored that into your analysis.
They get a participation.
They get a participation even if the asset isn't sold on October 2020. So the buyer can't gain when they sell it. Did you factor that in, or?
Okay. May I first clarify your question? So do you mean that if our whole period is 2020, and if we do not tell USB, then they could vacate because of our strategy of not giving them the participation fee?
I'm saying in 2020, if you have not sold the property, you still would owe them, I believe, the way I read it, you would still owe them some sort of participation based on an appraised value of the property on October 2020. But I could be wrong, but that's what I...
Thank you for this clarification. But at first, we do the understanding is that if we before 2020, then we need to pay the participation fee if we exit. But after that, then we
I
do
could have
not.
read it wrong.
Yeah, sorry.
That's what we.
That's
This is what we thought.
And answering the questions about the market rent, for the scenario A, we completely use what I mentioned in the case, just 1% incremental for the annual A. And for scenario B, for the 80% that we mentioned, we also use the 1%. But for the other tenants that we mentioned about the tech and legal, it will be subject to the market rent growth.
And my final question on this, by the way, I think that the fact that you went through all these different scenarios was very thoughtful. I mean, you
Right.
actually
Thank you.
had
Thank you.
a
Thank you for
good
that.
range of outcomes. If you do lease it up and go through all that operating risk, why is your cap rate so much higher in that scenario than say in scenario B? Just curious.
Exit
The
cap rate?
exit cap rate on scenario 3 is 7.5%.
Yeah.
And it was 6.4 in scenario B. Why do you have such a premium on the cap rate?
Right. First of all, really thanks for that. We can definitely go to the sales comparable for that. Like the reason why we want to have a cap rate compressions from a 7.9% initial rate to arrive at how much that we have remaining is actually all subject to the whales that we have at exit. And we do think, and how we arrive at that number of the exit cap rate, we comparing with the sales comparables that we have here. And the reason why, so for B and C is interesting, right? But both of them, the whale at exit is just 8 years. So the reason why for the 1% differential of the cap rate, we completely think from the perspective of the buyer. Because for managing a multi-diversified portfolios of tenants versus a single tenant portfolio, we do think that managing a diversified portfolio, they have variations of fail rate will be much bigger than that of a single tenant. So we do think that in that comparisons is not as favorable for C and B. But even if that is wrong, we do think that if we compress it even further, that's even better for our valuations.
Can you show us the cash flows for scenario A?
Sure.
Cash flow?
Let's perform. We got 5 years. Yes.
You're selling it at $225 million.
Yes, at a 6% cap rate.
But what did you have to spend in order to get the U.S. bank lease renewed?
Two things. First of all, it's definitely tenant improvements. So we're going to give them
30. We suggested 30 per square feet of tenant improvement. But as we exit in 2 years' time, but they have not renewed the lease at 2020 because we exit in 2018. They have not really signed the contract of. They just ensure us in 2018 the notice year that they will sign a contract. But we are exiting at 2018, right. Then we do not owe them that part of money.
Flipping it in 2 years.
They're just flipping it in 2 years, yeah.
Right, but then it's got to be reflective in the price that you get.
I think that explains in the exit cap that then the buyer of us will need to pay the tenant improvement for our strategy. But for them, then it's like a cash cow already because in A scenarios, then they just fully lease our spaces for 10 years. We try to exit to a core or core plus fund that in their case that they can just give the 30 tenant improvement for the very stable cash flows. That I think they will definitely go for it.
I think that there was some fees that you're going to charge or we're going to charge outside of just the cash flow participation of the loans. Is there a leasing fee or other fees?
The asset management fee?
It's just an asset management fee. I think I sort of narrowed down the leasing fee. Is that a third-party leasing?
Oh, right. The leasing commissions. Yes, we did factor that in as well for a scenario.
Embedded in the return to Viking.
Right. Yeah, it is. It is. We use the entire project to finance that actually.
So just an asset management fee leasing.
Right.
Yeah. Property management. Anything else?
Nothing. Property management is not for us. It's actually because it's a triple and
this range we are using.
So they do not need us to do any property management for that.
You go to scenario C performer?
Sure.
Performer.
C.
Performer.
Okay, C performer.
Performer.
You're leasing up when?
I think in 2020. We are here assume that we lease up in 2021.
One shot.
And use $40 TIs, is that what you use?
Yep, for a new tenant.
For a new tenant.
This is based on the market research. Yeah.
New tenants.
Is there any CapEx, or any improvements you're doing to attract new tenants to the building, basically?
You got okay. I'm going to take this. The one that we're using to attract new tenants, we're definitely going to have new TI, the $40 per square feet TI. But we're not going to have major capex for that because we think that the amenities there in the regions and also in the building is already very good. I think Nancy can go into details about how the regional amenities are already very awesome.
Okay.
But you're assuming multiple tenants, right?
Yes.
Right.
So you have to convert the building from a single tenant user to a multi-tenant user.
Right.
Well, actually, if I may, thank you. We have read the case that USB said themselves they have a very open floor plan, and at the same time we have noticed that the market trend is that people like from the tech industry or even the law firms, they are really going for this open floor plans to have like a collaborative workstation, and we already have that in place right now. So, we think that.
Yeah, sorry.
So also they say that their buildings in excellent condition. So we believe that we don't really have to do that much work to change that much things. Another thing we believe our property is very attractive is that our prime locations. Our property is located in this place called Nickel Mart, I think, which is the most amenity-rich region of the downtown Minneapolis. So obviously, people are really attracted to these kind of spaces and these kind of buildings. So we are pretty confident that we can draw in a lot more new tenants and without doing too much change.
Yeah, just to sum up, is that we are like providing them with a renewal TI for $40 per square feet, new TI, and then we are already a trophy building. We are refurnished. In this case, we do not think that we will have many major CapEx. And the new tenant, yeah, sorry.
And I noticed that you had a 3-month abatement, but that's pretty
Short?
light in terms of when you look at your lease comps. They're more,
Lease comps.
For your eye.
Yes.
Here we try to look at the second RBC Plaza lease comparables there. They give the rent-free period of 3 months, and we based on that because the RBC Plaza is in fact pretty much comparable to us, and they're leasing for 12 years there. So for you can see from the top and the second one, you can see that the first one paying 8 months of rent abatement, but in fact they are leasing even longer terms. Here we just emphasize we want a 10 years terms, so that we think that in the second one, the RBC cases, they give us a 12 leasing terms and they just provide 3 months of rent-free is sensible to us.
Oh, also, if I might to join in, actually for the 3 months abatement months, which is the second least comparable, actually this place is rented out by a legal firm called Frisch & Richardson, which is exactly who we are going to target. So we believe that this is the acceptable arrangement for them. While as you can see, that some of them have a lot more like a rent-free period. For example, like the first one. Well, however, the first one is actually leased by a place that's called industrial. It's called industrial workplace. I believe this is a co-working space places. So as a co-working space places, and they really do have to do like a lot more change in terms of a layout in building like their spaces for like separate companies and all that. So that's why they will have a much higher rent-free period. But they are in fact not who we are looking for.
How do you feel about your pace of absorption versus what the market's absorbing each year?
Our pace of
Absorptions.
How quickly you're going to lease the building?
Well, we are pretty confident that if we can have a look at the potential.
I'm not sure if I'm understanding correctly, but is it?
B or C?
I think it's B and C.
You have a 900,000 square foot building.
Right.
Yes.
But actually, we understand that they're going to expire at 2018. I mean, and they're going to tell us whether or not they're going to renew or not with us in 2018, right? So we actually have 2 years' time to work really hard to find the tenants that fit for us.
Also,
And then our whole period is 6 years, meaning that we will know in 2018, and then we will start looking for tenants, and then we will exit at 2022. So at 2022, that means a 4 years period for us to absorb the vacancy, and even after these 4 years of absorption period, we're also still assuming a above market vacancy rate in our investment outcome assumptions.
Right.
So we believe it's a rather conservative valuation model, and certainly more due diligence could be done to look at the comparables and whether this 4 year really is sufficient. But
yeah.
You guys go to page 14 for a second.
Sure.
Yes.
Your materials are really good. Really good.
14.
The first group to address the tax consequences of the election.
Yeah.
yes.
Thank you. Let's go back to that.
So I'm the seller now. If I'm looking at this one chart, I'm not going to sell you the building at 170. Why do I say that? Because just on per square foot, you know, good building, good location.
Right.
Look at the comp at 222 a foot. Look at the very dated comps. The market's up fairly dramatically the last 3-4 years. You know, I'm giving you a chance to woo me.
Okay.
Yeah.
So I'll try to do
The
that.
model spits out, honestly.
Sure.
Yes.
Sure.
Right, so
Why
tell me
not?
why I'm wrong.
Okay, you're not exactly wrong, but thank you so much for your question at the first place. We do want to win this bid within 2 months before the year end, but we're considering the seller motivation here. The seller FTF is a charitable trust, and there are 3 things that they really look at from this sale. The first, of course, the offer price, which you talk about. It might not be the best, but then the second motivation is that they really wanted discreet closure, which we can offer because we're the only bidder now. That's how we win over other bidders. And the third and most important factor that we considered regarding the seller motivation is that FTF just wants some bond-like cash flows. And since they're only offering to us but not other bidders the debt financing, since we're doing the debt financing with the seller, so essentially if they accept this deal, they can continue to have the bond-like cash flows, which suits their charitable trust interest.
Yeah, but they want their cake and eat it too. They're subsidizing the deal with, you know, below market debt. There's no call protection. The rate's the lowest.
But
They
that's,
want to get compensated for that.
Yeah,
So
I
they're
know.
going to be properly advised.
Yeah, thank you for this consideration. But in fact, in the case that they provide us a sense that they will like accept at most 200 million price that provided, and they'll say that they're happy with 180 millions, and then we found that in fact we try to just explore the chance that if we just secure this deal instead of just going too wild, because we believe that if we're flipping in 2 years, the return is really high. We just try to secure the deal in the first place, so we just don't go too aggressive in the pricing.
Thank you.
And actually, just to supplement a little bit about why we think that we cannot be too aggressive and bid too low for this if we really want to secure this opportunity within 2 months. Because obviously our house view is that there would be exit cap rate compression because of hot money flowing from China. But there is also evidence that there's capital, even if say the election result is that Trump, maybe there would no longer be so much capital inflow from China, but then there is still domestic capital shift. Because from the transaction comparables that William talked about, the buyers are actually from outside of Minneapolis. So there is, even if there's no hot money flowing from China, there could be hot money flowing from other places into Minnesota, which supports our house view that there will be an exit cap rate compression, so we cannot bid too low.
Right.
Yeah, this one.
So all in all, we are not looking at the first place we have an aggressive pricing, but we are aiming for a very, very promising exit return.
How come you guys never put Blackstone in the project?
I am so sorry. We made some errors in the logo.
They did see you in the morning. You should have been in the judge in the morning.
Study the process.
Mark and Johnson Thomas.
Right, actually.
Thank you very much.
Thank you.
Thank you so much. Thank you.
Yes, Captain.